perhaps you more or less know what capital markets mean, or you are the player in the capital markets if you invest in like stocks or like bonds. From an investor's perspective, of course, through the capital markets, we have a lot of opportunities to perhaps make a profit, and then for perhaps in the future, after you graduate, you are going to set up a company, and as a business, you need external financial sources, and the capital markets provide you opportunities to raise funds. And that's why capital markets, when we look at capital markets, we look through the perspectives of both parties, investors and companies, especially companies. But perhaps looking through the perspective of companies, this is a little bit far away from our daily life. You perhaps invest as an investor, and you will better understand how whether stock prices may change and what the change means and how to make investments. But perhaps of course, I'm not quite sure, perhaps some of you have experience of running companies or like your relatives and parents do, but from company's perspective, this is relatively far away from our life, and we'll dig deeper into these areas. And then, because capital markets are important for companies financing, so we will do the brief review to corporate finance. And let me start with, perhaps some content I already shown here with a very simple question. And feel free to try to recall what you did in business entities. You have some like lectures about perhaps shares and creditors and so on. And okay, so if, for example, in our classroom, some of you or 2 or 3 friends would like to set up a company, you have a big and promising business idea, you don't have enough money. So can you please tell me what you would like to find enough money to fund your business? Different approaches, perhaps. Sorry, may I have your name?
Lewis.
Lewis, yes, please.
Well, I suppose, again, if you're just starting a company, if you have any assets that you're going to be using for the company, the thing that would jump out to me is to create securities over them. So I think that's debt financing, where you take a loan, and then you offer up this asset with a security over it. So if you were to go insolvent, your creditor would then have priority over that asset for their debt.
Brilliant. So if you are going to set up a company, if you have your own money or your own assets, you have priority rights, you can invest no matter cash or other assets into this company. Then, because you are the founder, we assume that you are the shareholder. So all those are the equity capital of this company. But if they are not enough, you think you can use the asset to borrow from. Okay, my question is further, borrow from whom? Others can think as well.
Well, I suppose it would be probably from the banks.
From banks.
Who are probably the main loan givers. But I suppose you could probably look for private. I don't know the term, that my brain's gone so much that like a private person will give you a loan, but generally it will be the banks.
Yes, bank is especially in our scenario, if you're going to set up a company with perhaps just one friend of you, so it's a private small company and a startup in the business context as a startup, and you would imagine you have limited sources no matter to borrow or to later talk about to issue shares to external investors anyway, and the bank will also assess your business potential, and it's not that secure compared to a big company. You may not be able to secure the loan, so as you said, Louis, very good. You may consider alternatives to banks, private or professional lenders, and they have different names. Insurance companies can do so, or another different like private financial firms. There is kind of like but it's kind of beyond our course, but there's kind of like a called consumer credit agreements. To do this is an activity regulated by the FCA and should be authorized by the FCA as well. If the firm has this authorization, it can lend to businesses, including individuals, as no business. But of course, if our classmates are very nice, they would like to lend. Of course, this is kind of like a private loans. Then perhaps borrowing is quite important for startups. Then Louis, perhaps you and your friend would like to operate the company yourself, but you don't have enough money. And if you borrow, for example, if no matter the bank, another professional lender, all our friends would like to say, I can't lend my money to you for a long term, so I will request the maturity to be within 3 years, but you need much longer time. Let's assume 10 years to implement your business idea. Any alternatives? And others as well? Okay, sorry again, to the fee. May I have your name? Sorry, the girl.
I'm Alishba.
Alishba?
Yeah.
Can you start first and, sorry?
Jonathan.
Sorry?
Jonathan.
Jonathan, okay, please.
You can engage in equity-based financing, which gives you an injection of capital. So it could be via venture capitalists or private equity, and usually they'll give you an influx of funding and sometimes engage in the management of the company. And it can range as to whether they want you to pay back immediately, or it could just be they want returns.
Okay, brilliant. So if you look for long-term investments, of course, if the banks or other lenders would like to offer long-term debt to you, that's definitely fun. But usually there is a certain period. And then if you think about using another new choice to external investors, because when you did company law, you know those shares, if they are not redeemable, then they are perpetual. And as shareholders cannot ask companies to repay their initial investments. So you get the money to use forever. So that's quite important. And when we talk about equity financing, perhaps you can find an individual. If the individual is very rich, we call that individual high net worth individual, and as Alicia aside, or there are private equity funds, they are institutions. But what I want to highlight here is, in our scenario, Louis' company is a seed company. At the very beginning, whereas in practice, private equity will think about companies scaling up. Because we need to show some sort of achievements as kind of like evidence for your further performance. Private equity may look for relatively bigger companies or at a relatively late stage. That's practice. When venture capitalists may be more, well, they are prone to risk taking, which means they may love startups more. And okay, Jonathan, please.
I was just going to say 70 shares on family and friends.
Family and friends. Okay, so there are two different approaches to equity financing. Additional side, we could issue shares to externals, and Jonathan's side, we could think about parents or relatives and sisters and brothers could more like a family business, and we have all shareholders. Let's consider what are the differences between the two. Well, if you look for another shareholders, what are the differences? Sorry, may I have your name?
Ruben.
Ruben, yep, so
If you look to get investment from like an angel investor or a venture capital firm, somebody who has expertise, then you are also getting their advice, but potentially giving up more control because they'll want to be more active in the management of the company, whereas if it's your relatives who have no expertise in the field, then they're probably more happy to just leave you alone, let you do your thing.
Yes, brilliant. And how about families?
Well, yeah,
friends?
there's a personal, it's more, there's more personal relationships going on there. Like if the company gets distressed or goes bankrupt, then they will also lose their money. So I guess that adds complexity to it if you're dealing with family or friends.
Yes, if another shareholders, like if family members or close friends, they are individuals. One thing is they may not have sufficient funds, and in particular, if you want to expand your business, well, depends on whether they have enough funds or not. And if they if the answer is no, unfortunately, you may still need to consider private equity or external institutional investors. And I see some very good institutional investors, they are experts, they are professionals. They may want to be involved in management, and of course, if they require voting rights, as we know that as shareholders, we usually have cash flow rights and voting rights. They have voting rights. They share your controlling power, and you can't stay absolutely in control. And that maybe if there may be kind of like a dispute between original founders and private equity regarding perhaps the direction, and that may lead your business to another area or to another direction you have, which may be not consistent with your original idea. So that means that when we talk about equity financing, it seems very easy that you just issue shares to potential investors, and then they subscribe, they become shareholders. But considering who the shareholders are, then they may bring different pros and cons together to your business. Okay, so let's move on about equity financing. Is there any way that because we know private equity funds, venture capitalists, all the high net worth individuals, they are rich. They may provide adequate funds forever. And is there any possible way to attract their funds without giving up to your control, giving them management voting power? Yes, please. Yeah.
Of me? You want to
anything.
Okay. Well, probably if you don't want to give up control, then probably you give them preferential shares, which tend to be shares that give you preferences in dividends. So it means that your return from the company will get paid to you first, generally, but you don't get voting rights. So it means that you don't have control. That you could have voting rights attached to preferential shares, but they're very rare. Generally, preferential shares will be non-voting shares.
Exactly. Preference shares is one of the options, and Ruben, any other options?
Well, I don't know what the specific term for it is, but multi-share structures. So you give yourself a higher value of votes per share, or you give yourself a veto or something.
Brilliant. And that's called dual class shares. And that's one of our topics we will do in week 8. Yeah, we will do it in week 8. So two different options primarily. As Good Side, you offer, this is more traditional. As a company, you issue preference shares. They are called preference shares because they are preferential as to the payment of dividends, and also in the renting up process. They are only a higher fee, and they are after all the creditors anyway. Okay, so but there is a fixed rate, which makes preference shares quite similar to debt or corporate bonds in particular. So they are not entitled to all the surplus proportionally. That means if you make 10 pounds, let's assume, if you make 10 pounds, and if their rate is fixed at 1%, you only give the preference shareholders £1, and you have £9. So ordinary shareholders, if the upside is you can reap all the surplus after paying your creditors, after paying preference shareholders. But of course, the downside with preference shares, as Good Side, they usually do not carry any voting rights. But what I want to highlight here is usually they don't have any voting rights, don't have any say, but in very special circumstances, the law or regulation might mandate that preference shareholders have a say on any on a certain of money that will affect their interests. For example, perhaps you did takeover lectures last year. So if the takeover bid will affect their interests, and as a class, preference shareholders can vote on a files related takeover bid related to their own shares, but they can't vote for ordinary shares, of course. But that's rare. Usually they don't have voting rights. So that's a preference share is more traditional. Then another one is dual class shares, as Ruben said. We're not going to discuss in more detail, but just briefly mention a typical example is Google. It has it actually has 3 classes to make it simpler. 2 different classes of shares carry voting rights. The first class called superior class, shares, every share carries 10 votes. But we know as the default rule, every ordinary share should only carry 1 vote. That's one share, 1 vote. So the inferior class, or we call the ordinary class, they usually follow 1 vote. 1 share, 1 vote. The superior class, it depends. It really depends how the company would like to allocate the votes. And in Google, it's 10, and 10 votes for the superior class. This is kind of the common practice. Whereas it can be as high as 1,000 votes or even more, as long as there isn't any cap imposed by regulation. And currently in the UK, the cap is 10 votes. And there are proposed reforms to completely remove it. And in terms of the purposes or effects, we're going to discuss in week 8. So dual class shares and preference shares are kind of solutions for founders if you want to stay in control but they still want perpetual investments. And of course, as investors, you may know.
What about Berkshire shares? They also have Class A, Class B. Is that with different voting powers?
Oh yes, they usually call that Class A, Class B, and sometimes Class C as well. So companies, they will define in their articles of association whether Class A has more votes or Class B has more votes. And Class C, sometimes they have Class C without votes, quite similar to preference shares. Okay, we will look at Google as a case study in more detail then. All right, really. But from investors' perspective, as you are investors, do you prefer, well, not individual investors, if you are the manager of the private equity, do you like ordinary shares or preference shares? Okay, Luis.
Well, so if you're an investment firm, preferential shares aren't particularly attractive because, well, they might be, but it would have to be a very strong startup, because if you don't have control over the company, then the directors can make decisions that might impact, you might completely disagree with and put you at a greater amount of risk. And the benefit that you're getting from preferential shares isn't really a benefit, because when the company's winding up, all the other creditors will have priority over you anyway.
Mm-hmm.
And so you're only kind of getting essentially what's left over. You're getting the dregs anyway. So a lot of the time, you're probably going to be aiming for ordinary voting shares, unless you were certain that this company was going to make a load of money, and it was certain. Then you just want to get in at sort of any price anyway at preferential shares. That might be an option, but in general, you'll be aiming for ordinary shares.
Thank you very much. Yes, brilliant. So for preference shares, compared to dual class shares in particular, for preference shares, we usually call it a hybrid of equity and debt. So as a hybrid, because it carries some characteristics of debt, and if you prefer some safer options, or perhaps preference shares offer you perhaps a higher level expected returns compared to interests of debt, so interest of corporate bonds. So you may prefer kind of a balance between safety and returns. But if you invest in ordinary shares, well, as Luis said, unless you are very sure there is a high business potential. And when you invest in dual class shares, well, it depends on whether or not there are other arrangements to ensure your rights as the inferior class shareholders, whether you have some certain voting rights, or whether the dual class share structure will be cancelled or will be transferred into the ordinary structure after a certain period. We'll get into those questions later. In general, institutional investors do not really like dual class shares, but for preference shares, it's a traditional way to kind of balance between founders' control as well as financial sources and the availability of financial sources. So preference shares may be considered by investors who prefer a safer option. Okay, and of course, debt is also another option. Let's get back to the issuance of shares a little bit. You probably own, and I assume that you know that if you want to, well, in terms of to whom you can issue your shares, for if there are different requirements when it comes to private company and a public company. And as for private companies, according to company law, section 755, private companies cannot make a public offer of no matter equity shares or like corporate bonds or debt instruments. A private company cannot do so. So this is kind of like a prohibition. That means if your company in Louis' scenario, as a private company with only 2 shareholders, perhaps there are limited options, or this company can only reach a limited number of investors through private placements. Okay, whereas for a public company, it has many more choices. And here, let's just have a look at company law here. In company law, there are very clear definitions about exceptions as well, in which circumstances the offer will not be considered as a public one, as long as no matter how many the offerees are, as long as offerees are quite certain, you know that's because you make an offer to potential investors, but as long as those investors, you know this, there is a certain number of offerees, no matter how big the number is, and this offer, any subscribers will come from those group of people. This means that the offer is not available to other persons beyond this group of offerees. This will not be considered as a public offer, and this is one of the exceptions. Another one is if this offer is made no matter there is a certain number of offerees or uncertain number of offerees, because if the number of offerees are uncertain, you don't know who are going to be informed of the offer, then that is a public one, okay? But even if it's uncertain, number is uncertain, but as long as it's kind of like a private concern between the company and another person who is connected to the company, this offer will not be considered a public one either. So the company law also defines that someone who is connected with the company, for example, like employees, like directors, or the people connected to those directors and employees as well. So in most circumstances, let's think about some examples. As long as the offer is issued to existing shareholders or creditors or directors, or it's kind of like employee share scheme or like stock option scheme and so on, those are not considered making to the public. Okay, these are just the exceptions cited in the company law, not very clear because it's not very prescriptive. There is not a cap on the number, and arguably you may, in different circumstances you may argue whether this is made available only to offerees or not. Later we'll talk about crowdfunding. What I want to highlight here is because next week and the week after we're going to look at the issuance of listed stocks and getting listed and getting admitted to trading with respect to IPOs in the regulatory framework in the UK. And you will find that for disclosure purpose, there are different requirements or different definitions about a public offer. In terms of within the listing rules, there is a very clear quantitative standard for the time being. If this offer is made only to a group of people less than 150, to less than 150 persons, including legal persons as well, this is not a public offer, and then the company, the issuer, does not need a prospectus. We'll get back to this detail. Whereas if we do not have that requirement in disclosure or listing requirements, we just follow the company law. If you issue shares to 5,000 people, as long as you interpret your offer as not available to others apart from the offerees, you are able to define it as a non-public offer, then even if you are a private company, you don't know, you will not be, you do not reach this requirement. Okay, so this is difference. So that's why later, question. Okay, Louis.
I was just wanting to check something. So, private companies can't make a public offers of shares. But if you were, say, a private company, and let's say you wanted to offer public shares, could you create a shell company, essentially, a company that you own, a separate company owned by the private company, which is a public company, which you put in the Articles of Association, and then sell those shares of that shell company, and then because those shares are linked to your main company, it would essentially be the same.
So the shell company is a public company?
Yes.
Absolutely, yes. The answer is yes. And we call it, if the shell company is already established, we call it a reverse takeover, and we get back to that. And when we talk about dual class shares, we'll talk about SPACs, special acquisition companies. And then, we'll get back to these details, and that enables private companies to get indirectly listed on stock exchanges. Okay, and the answer is yes. So I just want to make it clear that when it comes to listing rules and disclosure for prospectus or those capital markets regulations, there are differences in terms of whether an offer is a public offer or not. Apparently, when it comes to capital markets law and regulation, the definition is kind of broader, which means requirements are stricter. Whereas it's up to the interpretation, sometimes or court interpretation, whether the offer is a public one or not. And let me quickly check. Do you know if a private company does make a public offer, so the court confirms that's a public offer anyway, what will happen? Let's assume that Ruben and Louis, I set up a private company and issued to everyone in the university and me to subscribe to my shares. What will happen to the shares? Anyone knows? Sorry, a little bit difficult. Which one do you know? What will happen to shares?
So presumably the shares could be rescinded, like the company might be forced to remove that public offer.
So could you please
like if the courts find the private company has made like a public offer of shares, then presumably they might have to rescind the shares or rescind the offer that they've made. So they have to like take it back.
Okay, yeah, sorry, can I have your name? So do you mean that the shares will be allowed?
Yeah.
Okay, so they are right. Okay, and Marco, yes.
I think as per the Companies Act, the courts might ask the company to re-register as a public company.
Yes. The courts may have different options, but the most common solution they offer is you reject as a company, you re-register as a public company, and then that will not the breach of the 70.55 proceed will not invalidate the shares. This is to protect if Ruben and Louis are innocent investors. This is to protect them. So usually the company will be happy to re-register. Or of course, in practice, companies would be happy to re-register first as a public, re-register themselves as public companies, and to ensure that they do not breach this rule. Okay. Let's talk about something about crowdfunding. A little bit controversial whether they breach what private companies issue no matter actually. Okay, just want to emphasize that Section 75.5, this prohibition applies to both equity shares as well as debt instruments. So we know as private companies, crowdfunding is a rising opportunity for them. So they have like platforms. You just disseminate your business idea, and you may solicit investors by offering equity stakes in the company, or you may issue debt instruments, or P2P lending is another thing. P2P lending is just it's purely loans, so they are not securities. We consider if the private company issues no matter equity shares or debt securities through crowdfunding, are they making public offers? That's not difficult, not easy to answer. Not easy to answer. Because some would argue, I think that's one of the arguments. Some would argue, no matter what crowdfunding platforms are, usually investors have to register or subscribe to the platforms first, and this may arguably mean the offer is only made to a certain number of investors, but I personally, I don't really agree with that. I'm not quite sure how you think. Okay, Ruben?
Well, it's not a limited number, right? Because it's not that you issue it to members at the point that you post your thing on the website. Like, it will go on for a period of time, and that time anybody can register. So it's not actually a defined number, right?
Yeah, I fully agree with you. This is what I think, because it's not a certain number of offerees, and anyone may possibly register himself or herself, and then may possibly become an investor. But as a matter of practice, as far as I know, no private company was considered having breached this rule. I think the purpose is that usually only startups have to resort to crowdfunding platforms because they have limited alternative financing sources. And then crowdfunding is quite important for financing startups or small companies. If the law or the court confirms that all companies who issue shares or debt through crowdfunding platforms, they breach Section 755, that will discourage not only platforms but also a lot of companies. So as a matter of practice, also because if you look at the size of capital raised through platforms, crowdfunding platforms, it's much smaller compared to the size of capital markets. So it does not have that very widespread impact for the time being. Or the answer is uncertain now. We don't know whether there might be any changes. At least I didn't notice any case law confirming that such an issuance through a crowdfunding platform is no breach. For the time being, that's really fine, but we don't know whether there will be any changes. Okay. So effectively, I think crowdfunding does allow startups to raise funds from the public, but the public is actually just, most of them now, they are still individual investors, retail investors. Okay, so this is about public offer and private offer. And in terms of the owner's responsibilities related to public offer, we will address these issues next week. Okay, so we'll probably also talk about the debt financing a little bit. Here, just want to introduce a very traditional concept, which is indirect and direct financing. You probably know, and indirect financing just means, as Louis flagged at the beginning, borrowing from banks. Okay, so why it is called, let's think about why it is called indirect finance. So you all have bank accounts. You deposit money in your banks. And what is the legal relationship between you and your bank? Sorry, can I give the opportunity to the boy there? Sorry, can I have your name?
It's Cameron.
Cameron.
Yeah, so, sorry, I forgot what the question was.
You deposit your money into your bank account. What's the legal relationship?
So it's not like a proprietary. So you don't own the money. It's like they owe you a debt. So you're a creditor, and the bank is the debtor.
Brilliant. So after you deposit the money into your bank account, the bank has priority rights, and you are the creditor. The bank is the debtor. And what do banks do with our money? Louis?
Again, they loan it out, usually.
yeah, they extend loans, then they become creditors and borrowers are debtors. So there are two creditor-debtor relationships. From the legal perspective, there are two debtor-creditor relationships. Despite that, when we look at this financial transaction or the financial structure, it's just banks take money and then they lend out. Okay, so here in between, well, we are depositors and the companies, let's assume they are and borrowers. And in between and borrowers and creditors, there is a bank. And then, do you feel safe if you deposit your money in your bank? Yes or no? Probably yes. You think your money is protected because you trusted the bank, and you think you have the credibility of the bank. So the bank uses its own credit to obtain the money from you, to borrow from you. However, as borrowers, perhaps like me, the first time we meet today, you don't know me. Do you feel safe if you lend your money to me? Probably no. You don't really know the end borrower, you withhold your money. So it's very difficult for the end borrower to obtain perhaps trust from thousands of hundreds of individual potential creditors. So the bank uses its own credit to ensure money or the funds, extra funds, are collected from the society and then allocated to those who are in need of them. So that's why when we talk about banking, commercial banking, and we think this is a mechanism of credit transformation. But let's assume that we have made a lot of examples that you can borrow from your parents, you can borrow from your friends. Okay, let's think about there is a personal tie. You use your own, as the borrower, you use your own credit, and there isn't any middleman in between. So that's why there isn't any credit transformation. You are not relying on others' credits. You use your own creditability or creditworthiness to borrow money from others. So this is the essential difference between indirect financing and direct financing, whether there is credit transformation. And perhaps you think there are so many intermediaries, brokers, they are middlemen. The difference is that we said there are two different legal relationships. Even if there is a broker, for example, not quite sure, but you may not have experience of securing a mortgage, but there are mortgage brokers. Mortgage brokers will only introduce you to the bank. You directly sign the to the lender. You directly sign the contract, the loan agreement with that lender. So there isn't anyone involved in the contractual relationship. The contract is directly between borrower and lender. So this is direct financing. Any question? Yes.
It's quite specific, but kind of the shift to kind of brokerages and investment banks using market makers. Does that then mean that we are shifting from direct to indirect financing? Because often the investment bank is buying the stocks and then selling them on to their clients.
Market maker, brilliant. So do I need to explain who a market maker is? Or Ruben, could you please explain?
I can try.
Yeah.
So essentially my understanding of it is that rather than brokerages or investment banks getting an invoice from their client and then just connecting them to a seller and being essentially a broker, instead a market maker will go out and they will buy X amount of the stock and then they will sell it on to their clients.
Brilliant. So the market makers, they are actually brokerage firms, we should say. They very frequently buy a lot of stocks or bonds and keep them, and when there are orders to purchase or to sell, and they will be the counterparty. Or despite that, commercially, they may do something which looks quite similar to banks, but the initial purpose of their role as to ensure the liquidity of stocks and bonds. So, although they are professionals and we may perhaps trust them a lot, but the essential role is not to perhaps use their own. It is not for market makers to use their own credits to use their own credits to channel the funds through. But their function is to ensure when there is a buyer or a seller, there is no counterparty to ensure the execution of the order. I'm not quite sure did I make this clear. Okay, and in fact, if you buy the shares from the market maker, you then become the shareholder, or if you buy bonds, you become bondholders' creditors from the legal perspective. Then you directly have the relationship, the contract relationship with the issuer. Whereas when the bank is involved, you will never have a contract directly with the end borrower. Can you see the difference? Okay, so the initial purpose from commercial perspective as well, market makers, their most important role is to ensure the liquidity of stocks and bonds. Without them, I want to buy shares, nobody sells. I want to sell my shares, nobody purchases. So that is the primary role of market makers. We'll perhaps mention them again when we talk about like inside the daily market manipulations. They are exempted from those prohibited rules. Okay, very, very good question. But of course, I want to mention some blurred boundaries about what we call agency or capitalism. So, aside the division between indirect and direct financing, this is quite a traditional concept. And nowadays, capital markets have been evolving very fast. And today, if you look at players, or if you look at perhaps FTSE 300 or Standard & Poor's 500, those very large corporations, you will find that the largest shareholders of those companies are investment funds, or the managers investment funds. Do you know any examples? BlackRock, for example, they have thousands of different investment funds. We usually call them mutual funds if they are available for us, for individual investors, and hedge funds for high net worth individuals and institutions as well. And you probably do not use pensions yet, and your parents do have pensions. So the pension funds manage people's or employees' pensions. They may themselves invest in stocks and different financial instruments as well. They are actually intermediaries because instead of like individual investors like us, instead of you may directly invest in corporate stocks or bonds. Alternatively, you can invest in a mutual fund, for example, managed by BlackRock or Legal & General. Legal & General is a UK-based investment firm as well. Then those funds, they collect money from people, and then when you purchase, proportionally you acquire a share of the mutual fund. Then the mutual fund collectively will invest all the money it has collected into a wide range of different corporate stocks or bonds or even derivatives, and sometimes they will also hold cash. And here I want to introduce briefly a very simple financial theory which is called modern portfolio theory. Not quite sure whether you have heard about that. If you Google, you'll find that the meaning actually is very simple. It means that please do not put all eggs into one basket. So when you invest, you have £10,000, you invested in one company. If this company fails, you just lose all £10,000. But if you only invest £100 in each company, you are able to invest in 100 companies. One company fails, it does not matter, as long as returns on your equity in other companies will exceed £100. So that is the idea of modern portfolio theory. Following this, that's why different mutual funds and investment funds arise. So you only have £10,000. You may widely distribute, but that's really kind of like an onerous work. but then they are professional, they collect a lot of money, they may invest very widely distribute new funds into not just 100 companies, but 10,000 companies, or including both stocks and bonds. So that's the idea of modern portfolio theory. So investment will not be very risky, even if one of the investing companies fail. Okay, so because this risk, very specific in this company, is effectively diversified. And just because this idea primarily, originally as a financial theory, but later have actually guided the development of capital markets, those investment funds become the main players and the significant shareholders in large companies. And when investors invested in those funds, they indirectly hold corporate bonds or corporate stocks through those investment funds. They become intermediaries. That's why today we call the modern capital markets as agency capitalism, because they are investment agencies, intermediaries. So that's why this concept is relatively traditional. And then today, instead of banks, investment funds are the alternative, but perhaps the most important intermediaries in capital markets. We will not look at investment funds quite a lot in our course. So that's why I hope to briefly introduce them, what perhaps in the academic arena, what are mostly debated in this area. Okay. So any question on investment funds? Sorry, can I have your name?
Aria.
Aria. Aria, please. Yeah.
But don't they sort of, in a way, this might be a silly question, but don't they sort of move the issue you're talking about with the portfolio theory farther down the line? Because if I'm investing in Jonathan's company and then Jonathan's company fails, that's bad for me. But if I invest in your investment fund and you're investing in Ruben and Lewis's company, and then your fund fails, that's still bad for me. So like, doesn't it move the issue of investing in one thing that might fail? Like it just shifts what might fail to a different thing.
I see the point, but the fund is actually the legal structure as the fund, what we call the asset manager, BlackRock, its own property or assets are separated from assets under management. So the assets under its, for example, it has only one fund. So these assets are owned by all investors in this fund. So the proprietary rights are not shifted to the asset manager. So the asset manager is just the agency. It is only the agency. If I use the agency relationship, is this clear? So it is only the agency for managing your money. And then if BlackRock fails, okay, so it goes bankrupt, and literally there won't be any impact on the money under management. And perhaps you will, it's actually very easy in practice. Perhaps we find legal and general to take over as the asset manager, find a new asset manager. So you are only exposed to risks in the investing companies. But when investing companies, there are thousands of investing companies, one failure will not affect the returns on the entire portfolio. That's the idea. Is this clear? Thank you very much. Very good question. Okay, let me just add a little bit complex. So what we said that the specific, the portfolio structure can allow investors to diversify risks specific in individual companies. But we know there are market-wide systematic risks about which may be economic or non-economic. For example, interest rates. The central bank increases or decreases interest rate. That country, there are geopolitical problems. For example, there is a war. Anyway, there is an entire or worldwide financial crisis. Your portfolio will not be able to diversify those risks. So something a little bit complex, but just let you know, it does not mean that your portfolio is absolutely safe. Okay, so that's it. Okay, very good question. And Shall we have a break? It's 10:03, so let's take 10 minutes break and we'll come back. Okay. You monitoring for free? No, I'm so sorry. Nobody would like to know. What do you want to? Okay, what do you want to charge? Interest. Okay, interest. And so let's think about from the lender's perspective. We know different debts carry different interest rates. How interest rates are determined? Okay, Luis.
Well, so the first thing that will determine interest rate is how risky the investment will be. So if, for example, if you're investing in, let's say, Google, a massive company that is very unlikely to go under, then you can charge a lower interest rate because you know they're not going to go into, you know that they're going to be able to pay their debt at the end of the day when the debt reaches maturation. And then conversely, if you're investing in like a startup, which is completely theoretical, that there's no other company doing that, and they don't really have any assets, they're completely new. There's a lot of risks that they won't be able to pay their debt, so you charge them a much higher interest rate, so you can get your money back sooner.
Brilliant. So the most important factor is actually the default risk, or we call credit risk, the likelihood that this borrower will not be able to pay off its debt. And there are different factors that affect the assessment or the evaluation of the default risk. Of course, Luis mentioned at the very beginning, in the first half, the security. So the lender may be happy to charge a lower interest rate if the borrower provides some security. And like for mortgages, let's take mortgages as an example, you need to use your house as this collateral or as the security. Otherwise, you're not able to secure this mortgage. Sometimes it becomes a mandatory requirement by the lender. And then let's also assume that if Luis is going to borrow my money, for example, for 3 years, okay, Marco is going to borrow my money for 10 years, or borrow our money, okay. Well, how high the interest rates should be in your own view? Okay, anyone would like to talk about it? How much would you like to charge Luis, and how much would you like to charge Marco? Different maturity periods.
Well, probably if Lewis is on a shorter term, then you're going to pay him probably less.
Lower interest rate. And then Marco will be charged a higher interest rate. And why?
Well, because Marco, you only have to pay back in 10 years. So you can afford to, like the benefit for him, he's more uncertain because he's not going to get his money back for 10 years. So he's going to want more money to cover the lack of liquidity. And for you, you don't have to pay him back for 10 years. So you have more time to make up that money. So you're willing to pay him more.
Brilliant. So the most important thing as a lender, what you give up is your access to your funds for a certain period. And if the period is longer, there is more uncertainty. You don't know whether at some stage his business or her business will fail. That's why you charge a higher interest rate. We know there are primarily two different ways to pay back for borrower to make repayments. First of all, so you only pay interest periodically, perhaps every month. And at the very end, you pay the principal altogether back. But we may add the principal and all interest during the period together, and you pay a fraction of the total amount periodically. We sometimes call it coupons. So that's usually how the mortgage works. That the whole value is divided into perhaps 20 years, and then every month there is a certain amount you need to pay to your bank. So that's how it works. When you charge a high interest rate, you get more at the early stages. For example, the first few years, when Marco's company is still working a while. However, you don't know what will happen if the period is longer, uncertainty is higher, there is a higher likelihood that at the very end the company will fail. if you charge a high interest rate, at least in the first few years, for example, you are paid, so you get paid. So that's why maturity period is also a significant impactor. And then, there are different kinds of factors lenders will take into consideration when they make creditworthiness assessments, like credit history. And as Louis said, if there is a startup, it does not have any history, okay, and various builders have a very good credit record. And some perhaps you have heard about credit rating agencies. Okay, so what they do, they are professionals. They collect different kinds of information about different kinds of companies, focusing on the likelihood of their default or their bankruptcy. And if this likelihood is very low, the company will be given a very high rating, like AA or A, and then B, something like that. So these kind of ratings will be adjusted, and investors in the market, they look at those ratings. They look at those ratings and they determine interest rates. Various startups, they even don't have ratings. It's really difficult, and they are usually in need to offer a much higher interest rate to attract investors. And that also happens. We usually focus. We focus on companies, which let's think about governments. We call yields of government bonds or corporate bonds as well. When the government, the yield of the government bond goes up, it usually means the credit of the government gets worse. On the other hand, if the yield, which is just the interest rate, goes lower, it usually means no matter politics, no matter economy in this country, are relatively stable. So interest rate, a high interest rate actually reflects a higher default risk. And of course, for investors themselves, lenders themselves, they may have different methods to hedge this kind of credit risk. We may talk about a little bit credit default swaps. If you don't know it, never mind. We get back to it in week 9. So it's simply, anybody knows credit default swaps. Okay, so like Ruben, I lent my money to Ruben, and I'm afraid that he may become bankrupt. So I have to go to Alicia. Alicia says, okay, don't worry, if Ruben defaults, I'm going to pay what he will lose. And then that is just the simple idea of credit default swap. It means that I'm imposed to Ruben's default, and now this kind of risk is shifted to Alicia. But sorry, Michael.
That's just like occasionary obligation.
What does it mean, occasional?
Sorry, we did this in commercial law last year, but it's essentially where one person offers to cover the debts of another to a lender, sort of. Like, for example, if someone owns a business and then they need assets to cover the business, their partner might offer their assets. Yeah,
that's different. That's not a guarantee. It's not guarantee. It does not mean that guarantee means the guarantee is actually the legal relationship is between Ruben and Alicia. Alicia is the guarantor, and when Ruben is not able to pay me, and Alicia will pay me, and then it's your own issue how to deal with the payment later. But my case is that Ruben does not know Alicia. They don't have any contract in between them. So I have lent my money to Ruben, but I'm imposed to decrease default risk. Then I'm taking some sort of protection or something. Well, credit default swaps are more like insurance. So I'm going to buy an insurance because I need to pay a fee. I need to pay a fee to Alicia because Alicia offers me kind of like a protection. When the default event occurs, when we may define in detail in the contract of the swap, when Ruben defaults, no matter completely defaults or partially defaults, anyway, so how much I am going to lose? will be covered by Alibaba. So this is a contract between Alibaba and me, and then in order to be protected by Alibaba, I need to pay her kind of like an annual fee. If Ruben does not default, Alibaba anyway will earn the fee. And Alibaba as a professional provider of financial services will issue thousands of hundreds of credit default swaps to perhaps all of the lenders of Ruben. That means if Ruben does not default, Alibaba makes a lot of profits by charging the fees. Otherwise, of course, on the downside, Ruben defaults significantly, and Alibaba will have to cover all of our losses. That is the idea, and there are also problems because let's assume that Ruben is an investment bank, and if this investment bank actually doesn't refund others, if it fails, then those providers of swaps will actually heavily exposed to this kind of Ruben's bankruptcy, and those providers of swaps are connected to this investment bank. The financial system is actually more intertwined inside. So that is what we call systemic risk, but it's actually beyond our cause. What I'm mentioning here is just kind of a credit default swaps. As an example that lenders did because the involvement of financial markets and financial instruments, there are many different choices for lenders themselves to seek protections or to hedge their risks. And if I do have no credit default swap, which makes me feel safer, I probably will charge a lower interest rate. That's the point. Or a little bit complex is securitization, but I don't want to make it too complex, so I will stop there. So there are different ways for lenders to protect themselves. And the availability of these different types of financial instruments, together with the modernization of the financial world, allow investors to charge lenders to charge lower interest rates. And this the good thing is companies, they may be able to use another's funds with lower costs. So later we'll talk about the cost of capital. So that's the idea. And if the concept of credit default swap confuses you, you can come to me after this class, or you may wait until week 9 when we discuss in detail when we talk about short selling. Okay, so right, we probably need to move on a little bit. Okay, we get here, cost of capital. You won't, well, as you won't pay you the interest, and the interest, when you want to use your money, I pay you an interest. That interest is, from my point of view, is the cost when I use another's money, right? So when it comes to debt, the cost of capital is just calculated by the interest or by the interest rate. And then how about equity? It's not certain because we know shareholders, apart from preference shares, for ordinary shares, let's talk about ordinary shares, what they can get is uncertain. It depends on how many profits the company has made in this year and whether directors would like to distribute. And right, so that's this kind of we call the returns on equity are uncertain. But as shareholders, yes, you probably have an idea generally how many returns you would expect from this company. For example, you think you need a return on equity. If you look at this formula here, the net profit divided by the value of total shareholders' equity is called the return on equity. It's a financial term. This is a percentage actually. If it's 10%, if your expectation is 10%, then you, after making some assessment, to think this company can only generate at maximum 5%. What will you do? Just stop. You will withhold your money. You will not invest in that money, in that company. You will only look for companies which have the potential for generating 10% or more returns on equity. Alternatively, if you figure out that the company cannot meet your requirement, the threshold, you may think about exiting from this country. Okay, so we in finance, it's not a requirement for you to fully understand this kind of like a calculation or the finance. But what I want to introduce is the cost of capital. Companies, when they raise capital, they need to pay. And from the financial perspective, the cost of capital is calculated by the interest of that or shareholders' expected returns on equity. Okay, so I know that some of you have a business background. So can I invite Ben to talk about what happened here is weighted average cost of capital. Could you please introduce this concept to law students? And if there are any questions, I can answer.
Yeah. So it kind of is just what it says on the tin. It's just the weighted average across the different ways which your company is being capitalized. So because I've got like a business degree in the background, so what we would use that for is you're basically using it to work out the cost of doing a project or a cost of doing something, and you calculate the average cost between, so you've used 70% of it's being raised through equity, so like you said, they got your return on equity at the top, and then the other part of it comes from your debt. So it's just because you're using both, so you have to even it out to sort of work out how much this is going to cost in the long run. You use it mainly for your net present values, which is necessarily, it includes the time value of money, because saying I'm going to make £10 million in 10 years, that means nothing. You need to know how much that 10 million is going to be worth now, and that's what we would use a weighted average cost of capital for. And do you want me to say much more about it?
Thank you very much, Ben, but I think the present value, those concepts may confuse some of.
As I said, I'm talking about like finance. I don't really know what you want me to say about in terms of this class for it.
But thank you so much for pushing us into this area, and I think the description at the beginning is very clear. Or shall I can I make a simple? Not quite sure. Do you have you got the idea?
I have one tiny question. So the weight bit, is that just the percentage of capital that you have raised?
Yeah, so if you see like the formula there, like the W, that's your weighting. So say if you're 50-50, you've raised £100 through debt and £100 through equity, that's just your weighting of 50% debt, 50% equity, so that's how it evens out to that weighted average,
Right,
as opposed to looking at them individually.
So it's the ratio just between debt and equity, not like weighted as in like time based. It's just
no. So it is just your capital portfolio, how you've raised your finance.
Thank you.
Let me make just in case this is a little bit complex. Let me make a simple question or simple example. Let's assume that a hypothetical assessment method for our course, 10% for group discussions or group presentations, and then 90% for the exam. Okay, so 10%. If you get 100 for the presentation, and then 90, that's too high, probably 70 for the in the exam. So, what's your final score? 10%. Well, your final score is the weighted scores of both parts, right? Your 10% plus 100, this is what you get, this is the fraction you get from the presentation, and 90%, not plus, multiply, and 90% multiply 70, right? So this is the basic idea here. So if in this company, the total debt capital makes 40% and total equity capital makes 60%, let's assume, then if there are that 10,000 equity capital, use the figure, the amount of equity capital, multiply the weight or the percentage, just the percentage of equity in the aggregate of equity and debt, then similarly plus the total amount of debt in the company and the percentage of debt in the aggregate of debt and capital. Debt and equity capital. Is this clear? Right. Okay. Perhaps I think I should write like let's use Ben's example, 50%, and then the value of equity plus 50% the value of debt. Okay. What I want to get you to discuss a little bit further. Yes. Okay. What question you have heard about? Companies need to make a decision whether they want to raise more debt or more equity, how to balance the weights between debt and equity. And then, of course, there are very complex factors. What we're talking about is cost of capital. Do you think debt may be cheaper than equity, and why? Okay, Ruben, why?
At a corporate level, your interest on debt is tax deductible. So a lot of businesses like to use debt to reduce their taxable allowance. And debt, if used properly, is a lot easier than equity because it is as simple as paying somebody back. Whereas equity, like you said, you've got people voicing their opinions and voting and all that issues. So people do tend to opt for debt. But it is cheaper, but it's not always better. Because I obviously won't go into it, but in finance you have your gearing policy and your ratios and that sort of thing. And there's the sort of picking order list. You start with your retained profit, then you go to debt, then it's equity. So equity is always considered not your first port of call. That doesn't always work if you're a small business, because they can't afford debt at the same time. So it's very business dependent, but debt is cheaper because of the tax deductibility, usually.
Brilliant, and that's a very important reason. And you highlight there are different voting rights attached to equity shares, and this is from the perspective of corporate governance. But before we get into the tax benefits attached to that, okay, Ruben, and
does it also open you up to hostile takeovers if you have too much debt?
Too much debt, hostile takeover.
If your shares become too low and you have too much debt, then other companies can just buy out your.
So if you have a very limited amount of equity capital, and then it's cheaper for takeovers to buy. Do you mean that?
Yeah.
Yes, probably. But we are talking about the structure, the percentages of debt and equity. So if the company has 90% of equity, but if the total capital is quite small, then it's also possible. It's not about the absolute value, it's more about we're talking about the structure. And sorry, may I have your name?
Dom.
Dom,
D-O-M.
Dom, okay, so Ruben?
I mean, it's, as far as I'm aware, a lot of it comes down to risk. It's the riskier the investment, the higher the return the investor's going to want. So the more senior your debt is, and debt is always more senior to equity, so it's always going to be preferred from a risk perspective. So the more senior your debt, the lower your risk, the lower the interest rate that the investor is going to demand, whereas in equity it's the highest risk, so the investor wants the most return.
Brilliant. Thank you, Ruben and Ben. So what do you have discussed are two most important factors I would like to introduce. Why we usually think, sorry, any question?
No, here.
I think Ruben and Ben have explained very clearly that on the one hand, from the investor's perspective, if your investments are riskier, you definitely would like to charge more. That's why when we look at interest rates of debt are usually lower than the expected rate of return requested by shareholders. This is one of the reasons, main reasons. Another one is what Ben said, that interests of debt are tax deductible. I think this may not be very familiar as to our law students. Let me make a quick example. Can you see the board clearly? Okay. So it's a pity that I don't think I can write here. Otherwise, that's easier. So you go. The company has both revenues this year, or this company needs to take out what the costs. Actually, costs for different kinds of like management and so on, like raw materials and so on. So after we got the revenues, we take out costs, not all kinds of costs, and what we get here called like a gross profit. So we got a gross profit here, and what we're going to do, we are going to, Ben, do you know what we are going to do here?
No, you're doing it differently to what
Sorry.
you do.
Sorry, this is a kind of a simplified, relatively like a simplified way. We are going to pay interests to our creditors. So at this stage, after taking out another costs, we are going to we're going to take out the costs of debt capital, only debt capital. So we are going to pay our interests to minus interest of debt. Okay, right. So we are going to take out the interest of debt because the interests are paid back to our creditors, to the lenders, and after that, we are going to tax on this part. Is this clear? So that means because you take out the interest of debt capital first before you tax on the remaining part, they are actually tax deductible. So this is corporate tax, and after you pay corporate tax, what you get is the net profit, net earnings, and shareholders are only entitled to those. So that means those interests will not be considered for corporate tax. That's why companies prefer to use debt to equity. Is this clear? Sorry, Ruben.
Just a question in terms of the accounting around preference shares, because they will have fixed rates of return. Do they qualify as debt for tax purposes, or do they qualify as equity for tax purposes?
They are dividends. They are not interests of debt.
Okay.
But the details of accounting actually I don't know. Sorry about that. But they are dividends, so they are not considered as interests. So that's the very simplified process of calculating corporate debt. Okay, so that's why they are. But as Ben said, it's not always better to use debt. What's the reason? Because if you have 90% of debt in your company has a higher risk of bankruptcy. Then both potential new lenders and potential shareholders would like to ask for higher returns on equity or interests. So the problem is that if these are fixed, if the return on equity or the debt they are fixed, okay. Sorry, here when we talk about the cost of capital rate, we use return on equity here, and we use interest rate. So you think that if they are fixed, this is constant, this is also constant. Of course, if you increase to 90%, the total amount becomes lower, and then it seems that you have to pay fewer costs for your capital. But actually, yes, the interest rate is not always constant. It will go up along with the weight of debt. When your company raises more debt, it's more leveraged, it becomes more vulnerable, and then both lenders and shareholders would like to ask for higher returns, expected returns. This figure here, interest rate will go up, return on equity will also go up, and perhaps, I don't know, but perhaps the total amount here, the result will be higher. So it's not always a good idea to raise as much debt as possible. If you don't quite follow the calculation, never mind. Just remember, that is cheaper, but it's not always a good idea to raise as much debt as possible because you need to consider the risk of bankruptcy. Okay? Any questions so far? I'm afraid we need to terminal. So I would like to perhaps go through this kind of like a basic concepts very quickly because I assume they are relatively simple. And if you don't know, perhaps just have to look at the slides later or the textbooks. I think because they are just some like concepts, not quite difficult, and we don't need to discuss in detail. For financial markets as a whole, they are for companies to raise funds actually, or conventionally we will divide them into different segments. What we follow is capital markets, and we do have like a very clear definition of capital markets. They are for the issuance or the trading of corporate equity shares, which are perpetual usually, and long-term debt instruments. Long-term will mean more than 1 year, with a maturity of more than 1 year. So if they are short-term, so in practice you will find that companies, their bonds are usually in long-term, 1 year, 2 years, 10 years. But governments and financial institutions like banks, they do very often issue short-term bonds or other debt instruments, and those instruments where they are traded or issued, we call them money markets. Now we're not going to look at money markets. So I want to clarify because sometimes I find that students may put them together. So as long as they are debt instruments, as long as they are equity instruments, all these markets are capital markets. But strictly speaking, short-term debt instruments, the market for short-term debt instruments are money markets, but we'll not particularly look at it because we focus on companies. Okay, so derivative markets, we do not do derivatives particularly. What we will look at in detail is just the credit default swaps only. Other derivatives we will not look at in detail. Derivatives, well, as the name suggests, their value derives from the value of another asset, perhaps a stock, a group of stocks, a bond, a commodity, perhaps gold, or a benchmark. A benchmark is just a large group of different stocks or bonds. Anyway, their value changes according to the underlying asset's value. And both derived markets and capital markets are highly interactive. And also from the regulatory perspective, you will find that some laws and regulations applies to both types of instruments. And later we'll talk about securities, the concept in law, and you will find in the US law, the concept of securities abroad includes derivatives as well, but it's not the case in the UK. Okay, foreign exchange market, you probably know, exchange of different currencies, and we will not look at it either. So what here, I just want to show you what capital markets exactly mean in no matter in the legal context or financial context, and what we will particularly focus. All right, so pretty much just what we have talked about. Primary markets and secondary markets. Any questions about this? I think this may be clear. So primary markets just companies issue shares to investors, and the parties shares or debt instruments. Parties are issuers, companies, and investors. Secondary markets are for the transactions of already issued shares or debt instruments. They are between different investors. Okay, brilliant. What is a little bit complex, as the regulators that us, but I don't want to confuse you, because if you look at the definitions, they look quite similar. I would like to say briefly speaking, in terms of their economic or commercial functions, I don't think they are pretty much different from each other. They are trading monies for, let's say, securities, for stocks or bonds in particular. But in regulation, they are defined in different ways. Like regulated markets are, let me make simple examples. Regulated markets are stock exchanges. Multi-trading facilities are junior markets. Organized trading facilities are actually just stock market platforms and systems organized by investment firms on a discretionary basis, which means the operators may decide to execute an order or not. I have no time to get into the details, and it's not necessary for you to remember all the details because what we usually address in our classes are regulated markets or multilateral trading facilities. Okay, brilliant. Let's quickly go through the concept of security. This is kind of very important. Security, well, the approaches to defining security are different in the UK. So we need to introduce what are securities in the UK. If we look at the FCX list, and there is an extensive and comprehensive list with like shares, debenture, and so on, and pension schemes, and so on. The difficulty is, if you just look at the list, you don't know what do they have in common. So what are the defining features of securities? And to make this complex, the FCA also has another concept. The UK law has another concept, which is financial instruments. And the difficulty is that it includes only tradable or transferable securities, and it includes another types of instruments. The most important purpose to introduce the concept of financial instruments is to bring financial instruments into the regulatory domain of the FCA. So if you issue financial instruments, if you market financial instruments, you need to comply with the rules set by the FCA. Whereas if your securities are not transferable securities, if you issue not transferable securities, the issuance is not regulated by the FCA. But we have an example when we look at crowdfunding. So I don't really want you to remember that this is not necessary because we will pretty much just do the traditional types of securities, like especially corporate stocks and bonds. From an academic perspective, well, it's not a legal approach in the UK, but I hope you can have a look at the US approach because it has a very general, broad definition of an investment contract. An investment contract will be a security in the US law, and it's called a full-proven test. It is an investment of money in a common enterprise with the expectation of profits solely from efforts from others. The fourth one is most important. You have money, you invest. For example, like me, I'm working here, I'm teaching you. I make a profit or make an earning perhaps, but I do make efforts myself. But if I don't make any efforts, the only contribution is just the money. This is an investment contract. This is a security. And this concept is really very broad. Compared to the UK approach, it may have some advantages because when there are new innovative types of instruments, they may be included in this concept. And then, as long as a new instrument can be defined as a security according to the Holy Test, it is regulated by the securities law in the US and then the SEC in the US. If you look at the UK approach, it's a little bit falsified because you need the lawmaker to reform the law to expand the list, and that is what the HM Cherry is trying to do to adapt to crypto assets. And we have a seminar about crypto assets. Bitcoins or stable coins, are they, well, we may call them currencies, but they are not really currencies. Are they securities? Can they be regulated as another securities? Leave this question to week 7, and then we'll think about it, and you will know the difference between the UK approach. Well, the different impact of brought by the UK approach and the US approach. And of course, does not mean the US approach is perfect because arguable whether an instrument can fit this test. This is arguable. Okay, so security. This concept of security is relatively important. If you have no time to review it now, perhaps in week 7, have a look at it again. All right. So we probably actually covered a lot about the functions of capital markets already. So the only thing is about the role of law. Briefly speaking, let me try to finish in 2 minutes. Briefly speaking, of course, capital markets function to provide opportunities for financing opportunities for companies, but at the same time, another important function is to protect investors. If investors are not protected, you probably will not trust the market, you will not invest. And then this is detrimental to companies as well. When there are a lot of investors, different kinds of investment approaches, if the markets are dynamic, for companies it's also good because they may be able to access different financial resources with a lower cost of capital. So, if denying capital markets requirements relying on the effective legal framework as well is very important for both corporate companies as well as investors. There are some like general descriptions about the functions, but I think you will understand better when we look at more substantive topics next week, from next week. So in general, what we're going to do in our following seminars, we look at a particular area of capital markets like a practice. We think about the potential risks to investors as well as companies. We think about the solutions provided by law, no matter well-established solutions or some of the potential requirements or debates whether those solutions, the current solutions, are effective or not. So this is a general idea. So let me just go through quickly. So here is the structure. In week 10, it's kind of like I will make a kind of like assessment later, or I will ask you later as well. Sustainable finance. I want to say that the exam questions will be based on contents from week 2 to week 9, excluding sustainable finance, excluding the basics as well. But the concepts we introduced today are important for our future seminars as well. So sustainable finance is my current research interest, but I'm not quite sure whether you are interested in or not. So if you're interested, but it's a very broad area. I figure out that I can't finish everything within like one seminar. So what I suppose is that in the last seminar we do both. I'm going to make, in the first half, I'm going to make a brief introduction to the ongoing debate in this area, but not delve into the details, but that'd be fun. So if you're interested, you can talk to me separately. At the same time, I'm going to summarize what we do from week 2 to week 9, and also for you to ask questions. And if we can't cover something in a particular seminar, and if I think if that issue is important, we can make up for it. Okay. Right. So pretty much what I want to emphasize is just here. And I hope that you will enjoy discussions from next week. And preparation is important given that contents are relatively intensive. Okay, so we will look at prospectus regulation. And just want to emphasize, this issue on this area, prospectus and listing regulations are under reform, overhauls. So we will focus on those reforms as well. And we may have some group discussions all together next week. Thank you very much for coming, and I'm very sorry for running a little bit late. And if you have any questions, I have an office hour exactly following our class for you guys. So from 11 to 12. So if you have any questions you want to ask, so we may just discuss somewhere here. And if you want to talk to me something more confidential, you can go back together with me to the office. Would that be fun? Okay.